Well, greetings, my beloved clients and friends. I wanted to talk to you today about a company that we just added to the portfolio. And we were looking for something to kind of diversify the portfolio. Sorry, huffing and puffing. We're a little bit tech heavy, and we wanted to put something to kind of balance that out. And so I had a few ideas, Charles had a few ideas, and we ran them through the ringer, and this is the one that won. And it was actually one of Charles' picks, so I got to give him credit for that. For last week, we've been tearing into it and kicking the tires and looking in their closets and behind the covers and everything. And we like what we see, so we decided to add it to the portfolio. And the name of that company is UPS. I'm sure you've heard of it. They are the largest freight transport company in the world. And we like to pick those leaders. It meets all of Benjamin Graham's criteria for a blue chip company, which are large, prominent, conservatively financed, good credit, and solid earnings. So I won't go too technical, but just tell you a little bit about the company. So first thing we want to know is that it pays a dividend of about 5.8%. So we like the sound of that. And they've been averaging paying of about 3%. That's kind of where they like to be. So it seems like management has a different idea of what the company's worth versus the market. And I think probably management knows a little bit better. So, and they also took about a 20% drop in the last week. And so that caught our attention as well. And so, what's wrong with this company, or is this an opportunity? And it seems to us like it's an opportunity. And so what happened was they had their quarterly earnings call, and they announced that they would be reducing the business they do with Amazon by 50%. And so the market didn't like hearing that, and it took the company way down, close to 20%, right? It was at 135 or so, and right now it's at 110. So it was down like 25 points. So it's almost 20%, right? 13 would be 10% times 2 is 26. So it's down about 20% from where it was just a week or so ago. And that price was down from its high of about a year ago. So it was already, in my opinion, pretty fairly priced. And then the market took it down. So losing the Amazon contract or that Amazon contract being cut in half, did that justify a 20% drop in price? Was one of the questions we asked. And I think the answer is a resounding no, and I'll tell you why. So the Amazon contract represents about 11% of their revenue. Okay, so losing half of that should represent about 5.5% of their revenue. Oh, and by the way, that Amazon revenue is some of their lowest margin business, right? In that contract, Amazon put the screws to them saying, you're only going to charge us this much, and they took it. But it's the lowest margin business they have. So even if it's going to represent maybe a 5.5% drop in revenue, it's going to represent a smaller drop in earnings in the bottom line, because it's their low margin business. So I could see this company going down 3 to 5% on that news, but 20%, well, I think that was unjustified. Okay. Oh, and by the way, UPS initiated that renegotiation of the contract. It wasn't Amazon calling them say, hey, we got bad news, we're cutting your contract by half. It was UPS negotiating to get out of that contract because they want to focus on more profitable type of business. And I like the sound of that. Okay, so And it's not uncommon for the market to do these kind of things, to overreact on bad news. And I'll give you an example that you might remember from, now this was over a decade ago. There was a oil spill in the Gulf, formerly known as the Gulf of Mexico, now the Gulf of America. And the company responsible was BP. And BP was a large global oil company. And they had this huge spill in the Gulf, and it was headline news. And, you know, the ducks were all full of oil and the birds and stuff. And it was a huge environmental disaster. And the stock on that news went from $60 to $30. The stock price was cut in half. And I was teaching a class at Mount San Jacinto College at the time, and we had just looked at BP prior, and at $60, you know, this is prior to the incident, we thought it was a little expensive, maybe around 50. And so with the new news, we actually did it in class. We reevaluated the company, and here's the deal: that spill amounted to it looked like the bill to clean it up and everything was gonna be about $25 billion, which is a huge amount, right? It would sink a lot of companies, but BP was huge. They had $250 billion in revenue the year prior to that spill. And so, I mean, are they going to enjoy writing a $25 billion check? No. But is it going to put them out of business? No. So what's the cost to them in as far as their valuation? And we looked at it and we said, know what? You know, maybe that company's only worth $40 a share. And it was trading at 30. So it seemed like an opportunity, right? And I think the same thing is going on with UPS. Should that loss of that contract with Amazon ding their valuation a little bit? Yes. Maybe on the order of 3 to 5%, but should it have dinged it 20%? No. So I think it represents an opportunity. That's why the yield is so high. Looking at the company there, like I said, they're number one global freight distribution company in the world. 70% of their business or so comes from the US and 30% is international. They're not number one internationally, DHL is, but they basically have a duopoly in America, them and FedEx. The US Post Office also ships packages. But here's something interesting that we found out, that DHL had been in the US market. And they're one of the big three globally. They tried to get a footprint into the US market. And after several years, they closed up shop around 2009. So that suggests that they have a pretty wide moat, that it's going to be tough for someone to shake up that duopoly, to come in and be the third big player. You know what I mean? It's just the incredibly high fixed cost to that business. Maybe Amazon could do it, but they don't seem interested in shipping besides what for their own merchants. But so we like that. We like that they have basically a duopoly and a huge moat around them. They generate a ton of cash. And here's the thing about this company. Here's what we think we could get over a 3-year period. Obviously that 5.8% dividend, which they've been raising every year for like 30 years. Plus, we think that company's worth probably conservatively $140 or so, in that range, that it could very comfortably be in that range within the next 3 years. So maybe because we're buying it at what we perceive to be a discount. This company has to do nothing, just continue to be itself, and we think we could get about 10% annual appreciation, 5.8% annual dividend, for total return 15% plus, without any good news or without any breakthroughs or without anything exciting, them just continuing to operate the way they operate. So, 15% return on a pretty conservative investment is pretty good. And we had a lot of T-bills in the portfolio when we could get 5.3%, between 5.3 and 5.5% on short-term T-bills. Now we're getting maybe 4.25%, and so I think for some of that T-bill money, this would be pretty good. It's a 5.8% dividend with some upside. And so what is the upside beside the fact that it's trading at a discount? Well, they're pretty well run, but they've announced that their net margin is 6%. And they said that we see some areas where we could improve our operating efficiencies, getting out of this low margin Amazon account, and some other things that we could do, employing technology to make our operations more efficient. So we think we could get our margins up to 12%. So without any increase in revenue, if all they did was take their net margin from 6% to 12%, they double their earnings. And so if they're able to do that, not any type of taking over new markets or coming out with a new product, just a little bit more efficient with the business that they are doing, they could double their earnings. And I think that's, at that point, that's easily a $200 stock. That's the upside, above the 15% baseline returns that we expect annually over the next 3 years. That's if they're able to execute. So that's not why we bought it. We bought it because even if they don't execute, we think we get a 15% return. And that's the type of business we want, because we have some companies that are in the portfolio, and if they achieve certain metrics, we could get some really good returns. We like this one because even if they don't, all they got to do is continue doing what they're doing, and I think we're going to get some pretty good returns. The other thing is that I think they're in a good industry. There has been, and there is continuing to be a shift to buying online, and so that's, instead of going to the store and buying something and bringing it home in the back of your car, you just buy it from your computer or your phone and it gets shipped to you, right? More and more people are doing that. The younger generation is more and more comfortable with that, even the older generation. And so we think that's a growth area, that, the shipping of goods will continue and grow. And so they're in a good market. And, even if you just get GDP growth of 2 to 3%, that rising tide will lift their business a little bit. So we see potential for revenue to increase a little bit. But that's not what we're counting on. That would just be gravy on top of the returns that we think we could get from that dividend and from the fact that it seems to be trading at a discount. So what could be some of the risks that we should be concerned about? Like I said, competition's tough. The post office loses money. Maybe Doge, the post office gets Dogeified. Charles invented that word, and that goes to the private sector. They would be a benefactor of that. So that's not a risk. That's another opportunity. But what else? What could be a risk? That less stuff gets shipped. And what would that look like? Well, consider the transition from mail to email, right? You used to have to someone physically deliver a letter to you or from you, right? And then that was replaced with electronic mail. It's faster and cheaper, no delivery costs and no delay time. Same thing with like Blockbuster, right? You used to go to the store and pick up the movie, watch it, and take it back. And then Netflix said, we'll just mail it to you. You watch it and mail it back, right? And then they said, we'll just send it to you electronically. And you could watch it whenever you want. So that transportation cost got eliminated. Same thing with CDs. You'd have to go buy a CD to listen to music, pop it in your stereo in your car or home. Now you just get that music sent to you electronically, so the shipping cost has been eliminated. Could it be possible that in the future you could see something that you like online and you buy it, and instead of it getting shipped to you, some electronic code gets sent to you and you just 3D print it at your house, or you just enjoy it virtually in your little virtual world? That's possible, and that could cut into the volume of stuff they ship, and we have an eye on that in the periphery, and there's a precedent for it, but I don't think it's a big immediate threat. But something that we're thinking about and keeping an eye on. We just asked ourselves, what could go wrong? What could go wrong? What could go wrong? And DHL's not coming in. I mean, they tried and they failed. Amazon could be a threat, but it doesn't seem like they're trying to go that way. So yeah, I mean, we like it. It seems like a bulletproof type of company. Obviously, there's always downside risk. Another reason it was down recently was because Trump's talking tough on tariffs, and they say, well, tariffs could slow down the economy and less volume, shipping volume, and it could affect them. Another thing that we considered was fuel costs. What if fuel costs go up? What if fuel costs go down? Well, we found out they're hedged on their fuel costs. So we kind of got a little bit excited because Trump said he wanted to drill, and if fuel costs went down, that would affect them positively. But turns out they hedged their fuel costs, so they wouldn't really benefit materially from a drop in fuel costs, but they wouldn't be damaged materially from a rise in fuel costs either. So, I mean, looking at everything, we looked at the financials, they look very strong. The dividend, they raised it a while back in 21, because if you consider COVID and people were stuck at home with this check, and they bought a bunch of stuff, and it really was a benefit. It really was a boon to those shipping companies. They were shipping all kinds of stuff, and they had a boom year in 20 and 21, and they raised their dividend from $1 a quarter to $1.50 a quarter. And at the time, that represented a 3% yield, which is where they want to be. But since then, the stock has come down, and I kind of think in hindsight, they might have raised it too much. And maybe the amount they're spending, like over $5 billion a year to pay that dividend, they could handle it with their earnings. But maybe possibly it crowds out some other investing. Like they should be buying back their stock at this price. And they announced that they're going to do $1 billion worth this year. But they could, if they didn't have that huge dividend, maybe they could buy back more. So, in hindsight, maybe they shouldn't have raised it so much. But we looked at their that was 3 years ago now, and we looked at their cash position. Has it caused their cash position to be deteriorated, or their debt to go up because of the burden of paying this dividend? The answer was no. So it shows that they could handle paying that dividend. And they've raised it every year since then. So I feel pretty good about that 5.8% dividend, plus some upside on the stock. So that's why we decided to add it to the portfolio. So if you have any questions or comments, feel free to shoot us a note. And also, now that you own UPS, if you ever need to ship something, go with the company you own. Send business to them. Okay, we encourage you to do that. We're going to do the same. So if you see something from us that we had to ship to you, we're going to be using UPS from now on. Well, as long as we own the stock. All right. So hope that was helpful. A little bit of, a tiny bit of the insight that we gleaned in our week of a deep analysis of this company, just to let you know why we bought it. And if you ask, like, why did I buy UPS? Well, there's your answer. So hope everybody has a great day.